The Goldman Sachs office in London on the 7th floor of the Plumtree Court building had a specific smell at 3 in the morning. It was the smell of cooled coffee, ozone from overheated server racks, and the faint chemical tang of new carpet that had never been walked on at that hour. A junior quantitative analyst named Daniel, his last name is redacted from the internal memo, was staring at a screen that showed something his models could not explain. He had been running the same simulation for 11 hours, and every time the result was the same. A pool of retail traders connected through a copy trading platform had generated a pattern of returns that beat the Goldman Sachs Retail Sentiment Index by a margin that should have been statistically impossible. The pool was not run by a hedge fund. It was not run by a quant team. It was run by a self-taught trader in a rented office above a tire shop in Stoke-on-Trent, and his bot had done something that made the data look broken. Daniel ran the simulation again. Same result. He checked the source data. Clean. He checked the timestamps. Continuous. He checked for survivorship bias, the classic trap where only the winners remain in the data set. The copy pool had been operating for 19 months, and the bot had traded through every market condition in that window. The win rate was 37.2%. The average winner was 4.1 times larger than the average loser. The Sharpe ratio, the standard measure of risk-adjusted return, was 1.8, which placed it in the top 2% of all systematic strategies the Goldman team had analyzed in the previous 5 years. And the bot that achieved this was running on a single rule: one indicator, one entry condition, one exit condition, no machine learning, no neural network, no hidden optimization. The bot was so simple that the quant team initially assumed they were looking at a data error. Here's what nobody on the trading floor expected. The quants had been trained to believe that complexity was a proxy for sophistication. Their models used thousands of variables, dozens of risk metrics, and real-time feeds from every exchange in the world. They had teams of PhDs optimizing every parameter. They had server racks that could process more data in 1 second than the retail bot had processed in its entire existence. And yet, in a specific set of market conditions, the final hour of trading during periods of expanded spreads, the retail bot consistently outperformed every institutional model the Goldman team had tested against it. The quants initially blamed randomness. They blamed luck. They blamed the small sample size. But the data kept coming, and the pattern kept holding, and eventually they had to admit that something was happening that their framework could not explain. The copy pool that Daniel had discovered was not a typical social trading group. It was a cluster of accounts on eToro that had been automatically replicating the trades of a single lead trader since January of 2022. The lead trader was not trying to build a following. His profile had no bio, no profile picture, no marketing language. He had a bot that executed one rule, and the only reason other traders had started copying him was that his bot's performance graph was a smooth upward slope that looked like a flight of stairs. The quants had seen those graphs before. They usually turned out to be back-tested overfitting, a strategy that worked perfectly on historical data and failed instantly in live markets. But this one was live, and it kept working, and they could not understand why. You just watched a quant team confront something their models never allowed for, that a single rule bot could outperform their entire infrastructure. That contradiction is exactly what this channel exists to expose. The moments when institutional frameworks fail because they were built on assumptions that never held. Subscribe now if you want to keep uncovering those blind spots, because the next layer of this story only gets more inverted. And drop the word theory in the comments if you see the irony. The Goldman memo had the prediction years before the data existed. The internal memo that Daniel wrote after that all-nighter is still in the Goldman Sachs research archive. It is titled Social Influence and Retail Trading Behavior, and it was circulated in early 2018, long before the copy pool had been discovered. The memo argued that retail traders operating in copy trading networks exhibited behavioral patterns that were not captured by standard models of rational decision-making. The memo was filed away and largely forgotten, but the data from the Stoke-on-Trent bot made the quants go back to that memo and read it again, and this time they saw something they had missed the first time. The memo contained a prediction. When retail traders copy a simple, consistent strategy, the resulting network effect amplifies the strategy's impact in ways that are not additive but exponential. They had written the theory years before the data existed. Now the data was staring at them from a screen in a darkened office at 3 in the morning, and they had to decide what to do with it. If the level of detail matters to you, if you are the kind of trader who wants to understand not just what the market does, but why it does it. Keep reading. The next layer of this story is where the real inversion begins. The Goldman team started reverse engineering the bot. They pulled every trade from the copy pool's history. They mapped the timestamps against market conditions. They built a simulation of the bot's logic and ran it against institutional data feeds. And what they found made them sit back in silence. The bot did not enter trades during normal market hours. It only entered during the last hour of trading, between 1500 and 1600 Greenwich Mean Time, and only when the spread on its chosen instrument widened beyond 1.2%. That was the entire entry logic. The exit logic was even simpler. Close the position when the spread returned to the 10-minute moving average. The bot had no opinion about direction. It had no opinion about volatility. It had no opinion about anything except the relationship between the current spread and its historical range. It did not predict. It did not forecast. It waited for a specific configuration of market inefficiency, entered and exited when the inefficiency resolved itself. That was the entire strategy.
We can't
The
optimize
quants had
the
been
sharp
trained
without
to build
addressing this
models that
drawdown
predicted
sequence.
price
The win rate
movements.
suggests an
They
anomaly
optimized
here.
for
Yes.
win rate,
Check the
for total
corresponding data in
return,
the model.
for maximum sharp. They believed that winning meant being right more often than being wrong. The retail bot did not care about being right. It cared about the size of its winners relative to its losers. And in the specific market condition it had been designed to exploit, the final hour of trading in instruments with expanded spreads, winners were systematically larger than losers because the institutional algorithms that dominated those instruments withdrew during that hour, leaving the market in a state of structural inefficiency that the bot was designed to harvest. The psychological inversion at the heart of this story is simple and brutal. The quants believed that speed was everything. They built systems that could execute trades in microseconds, that could detect patterns invisible to human eyes, that could process more information in a single trading session than a human could process in a lifetime. And they were right about speed being valuable in normal market conditions, but they were catastrophically wrong about what the market becomes in its most fragile moments. When liquidity dries up, when spreads widen, when the institutional algorithms withdraw, and the market becomes a shallow pool of nervous retail orders, in those moments, speed becomes a liability. The fastest algorithm in the world has nothing to exploit when the market has no liquidity to trade. The retail bot, which had no speed, no data volume, and no institutional infrastructure, was perfectly adapted to those moments because it had never been designed for anything else. That inversion, speed as liability, is not a theoretical insight. It is a pattern you can use the moment you stop believing what the institutions sell you. Subscribe now to join the few who understand that the edge is not in faster data, but in waiting for the conditions only you can see. And in the comments, write the one market condition where you have learned to do nothing. I want to hear which moment made you realize patience was the real weapon. The builder of the bot, whose name the Goldman team eventually tracked down through the copy pool's public data, was a former truck driver who had spent 18 months testing a single rule in a rented office above a tire shop. He had no background in finance. He had no degree in mathematics. He had learned to code Python from a book he bought at a used bookstore, and he had written the bot's core logic in a single weekend after realizing that every indicator he tested added noise instead of signal. The comment log for the bot's codebase from that weekend shows a file called strategy.py that was written in one sitting. No edits, no revisions, no optimization. The bot that broke the Goldman Sachs models was written in one afternoon by a man who did not know that his approach was supposed to be impossible. The quants could not replicate the bot's performance. They built their own version of the strategy. They optimized the entry parameters. They added risk management layers. They back-tested it against years of institutional data. And every version they built performed worse than the original. The more they tried to improve it, the more they broke what made it work. The bot was not a collection of optimized variables. It was a single coherent rule that had been forged through 18 months of watching a market behave in ways that institutional models said it should not. The builder had not optimized. He had observed. And the difference between those two approaches is the difference between the quant team's failure and the bot's success. The irony is that the Goldman team had all the tools to discover the bot's edge years before the bot existed. Their internal memos had identified the theoretical mechanism. Their data feeds had the same spread data the bot used. Their infrastructure could have run the same simulation in seconds. But they never looked because they never believed a one-rule strategy could outperform their multi-factor models. The assumption was so deeply embedded in their culture that it never occurred to them to test it. They spent millions of dollars building increasingly complex models to solve a problem that a truck driver had solved with 3,000 lines of Python and a rule he wrote in one weekend. The significance of this story is that the structural inefficiency the bot exploited is not unique to that trader or that instrument. It is a feature of all markets dominated by institutional algorithms. The quants build models that work in liquid conditions and fail in illiquid ones. The moments of maximum vulnerability, the final hour of trading, the minutes before major news events, the periods of extended volatility, are the moments where the institutional algorithms are at their weakest. And in those moments, the market rewards strategies that are not faster or smarter, but simpler and more patient. The bot that made Goldman Sachs restructure its models was not a technological breakthrough, it was a behavioral breakthrough. It demonstrated that the market, in its fragility, rewards a kind of intelligence that the institutional models cannot capture. You have been told you need better tools, faster data, more indicators. The bot that broke the Goldman Sachs models had one indicator, one rule. It was a weapon you already own, your ability to wait. If that makes you feel something, subscribe now. The trader who built the bot was not trying to beat the market. He was trying to find one configuration of conditions where he could trade with a statistical edge, and he was willing to wait as long as it took for those conditions to appear. The quants were trying to trade every condition. They believed that a good model should work in any market. The builder believed the opposite, that a good model should work in one specific market condition and do nothing in all others. The bot's rule was designed to avoid normal conditions because normal conditions are where the battle-tested institutional algorithms dominate. The bot only traded the conditions the institutions could not model, and in those conditions it had no competition. The question the Goldman team could not answer, the one that made them sit back in silence, was not about the bot. It was about themselves. How did a truck driver with one rule outperform their multi-factor models? The answer is in the gap between what they were trained to value and what the market actually rewards. They were trained to value complexity, speed, and data volume. The market rewards simplicity, patience, and specificity. The bot was not smarter. It was more aligned with the market's actual structure, and the quants could not see that structure because they were looking through the lens of their own assumptions. The restructured model that Goldman launched in 2021 included a variable called the social copy trading signal. It was the institutional version of the Stoke-on-Trent bot's logic. It could detect when copy trading networks were forming around specific instruments, and it adjusted the firm's exposure accordingly. But the signal was only 30% as effective as the original bot. The institutional version was optimized for risk management, for governance, for compliance. It was designed to fit inside the existing framework. The original bot had no framework. It was a single clean observation, unmediated by any institutional filter, and that was precisely why it worked. The final layer of this story is the one the Goldman team never published. The internal report on the Stoke-on-Trent bot included an appendix that analyzed the bot's behavior during a specific market event, a flash crash in May of 2023. During the crash, the bot did not enter a single trade. The spread did not widen beyond the 1.2% threshold because the market had become so chaotic that the spread metric itself became unreliable. The bot saw conditions that did not match its rule, and it did nothing. It sat flat for the entire crash. The institutional algorithms, in contrast, fired off hundreds of trades during the crash, most of which failed. The bot's edge was not just in knowing when to trade, it was in knowing when not to trade. And that discipline, the ability to wait, is the one variable the institutional models could never code. One thread remains open, the identity of the trader, why he built the bot, what he saw that the quants could not. That answer changes everything you think you know about who wins in this market. The trader's rented office above the tire shop in Stoke-on-Trent had a window that faced the motorway. He told a local journalist, the only interview he ever gave, published in a small regional paper and later archived by the Goldman research team, that he would watch the headlights of trucks passing at 4 a.m. while his bot ran its daily checks. He had been a truck driver for 11 years, before a back injury ended that career. He had saved £23,000 from his time on the road, and he had spent almost all of it on office rent, a used desktop computer, and the electricity to keep the machine running 18 hours a day. His wife had left him during the second year of testing. He told the journalist that he understood why. He had nothing to show for his obsession except a bot that made small, consistent profits in a market window that no one else seemed to care about. The Goldman team, after completing the reverse engineering, attempted to contact the trader. They sent 3 emails to the address listed on his eToro profile. They received no response. They tried the phone number associated with his account. It was disconnected. They sent a letter to the tire shop address through a legal services firm. The letter was returned, marked as undeliverable because the rental office above the shop had been vacated. The trader had left no forwarding address. He had left no trace. His bot stopped trading on July 14th of 2023, 19 months after it had started. The last trade in its history was a winner. The bot's final balance, recorded on the copy pool's public dashboard, was £43,217. The trader had turned £23,000 of savings into $43,000 over 19 months, a compound return that would be unremarkable for a hedge fund, but extraordinary for a single-rule bot operating on a consumer platform with no institutional infrastructure. And then he vanished. The Goldman team's internal report speculated on why the trader stopped. One hypothesis was that he had achieved his financial goal and simply walked away. Another was that the platform's algorithm changes had made his bot's single rule unviable. A third, written in a footnote by the report's primary author, suggested that the trader had realized something about his own creation that made him unwilling to continue. The footnote read, "The operator may have recognized that the copy trading network was altering the instrument's spread behavior in ways that his rule was not designed to adapt to. His edge depended on institutional algorithms withdrawing during the final hour. If enough copy traders replicated his strategy, the cumulative volume could change the spread dynamics and eliminate the inefficiency he was exploiting. He may have stopped not because the strategy failed, but because it was becoming self-defeating through its own success." The report did not reach a conclusion. The trader was never found. This is the part of the story that the Goldman team never fully integrated into their models. The copy trading network had created a feedback loop. The bot's success attracted followers. The followers replicated the bot's trades. The replication increased the bot's impact on the instrument's price. The increased impact changed the spread behavior that the bot was designed to exploit. The mechanism that made the bot profitable was also the mechanism that would eventually destroy its own edge. The bot was not a perpetual motion machine. It was a temporary inefficiency in a system that was constantly evolving to eliminate such inefficiencies. And the trader, perhaps alone among everyone who had seen the data, understood that his creation had an expiration date. He did not try to adapt it. He did not try to optimize it. He walked away. The trader understood his bot had an expiration date, and he walked away without trying to save it. That kind of discipline, knowing when to stop, is the one thing the quants could never code into their models. Subscribe now so you do not miss the final piece that changes everything you think you know about who wins in this market. And in the comments, write the one thing you have walked away from that made you stronger, your own expiration moment. The quants, in contrast, spent 2 years trying to build a version of the bot that could survive its own success. They added adaptive spread thresholds. They implemented volume-based position sizing. They introduced conditional execution logic that would reduce the bot's activity when copy trader density exceeded certain limits. And every version they tested performed worse than the original, not because the modifications were bad, but because the modifications introduced new assumptions that the original bot never needed to make. The original bot had no model of its own success because success was never its goal. It had one rule, one condition, one behavior. The modifications turned a clean observation into a fragile simulation. The bot had been perfect in its simplicity. The improvements made it complicated, and complicated strategies fail in ways that simple ones cannot predict. The trader's disappearance left the Goldman team with a question they could not answer through any model. They had reconstructed his bot. They had mapped his strategy. They had documented every trade in the copy pool. But they had not understood the man, and that gap in their understanding meant their reconstruction was incomplete. They had tried to build a better version of his bot, and they had failed, because they had tried to improve something that was not designed to be improved. It was designed to be executed. And execution, in the end, is not a question of optimization. It is a question of discipline. The internal report that Goldman eventually published contained a withdrawal of their earlier analysis. The retraction was tucked into a final section, written months after the initial memo had been circulated. It stated that the bank's recent data collection had revealed that the copy trading pool's performance had declined in the final months of its operation, and that the strategy's apparent edge had been a product of specific, non-recurring market conditions. The report concluded that institutional investors should not attempt to replicate the bot's approach. It was a quiet, bureaucratic burial of a finding that the firm did not know how to use. The bot had been studied, documented, and dismissed. The conclusion was not that the bot was right, it was that the bot's success was an anomaly that the institutional framework could not accommodate, and therefore it had to be explained away. The truth is simpler and harder to accept. The bot worked because it did not try to do everything the institutional models tried to do. It did not try to predict. It did not try to compete. It identified one specific condition in which the market became predictable, and it acted only when that condition was present. The rest of the time, it waited. The discipline of waiting is the hardest variable to model because waiting produces no data. A bot that does nothing for 93 minutes generates no trades, no signals, no patterns for a machine to analyze. It is invisible to the very systems that are designed to detect it. And that invisibility, in a market crowded with algorithms that must be constantly active to justify their own existence, is the most powerful weapon of all. The rented office above the tire shop in Stoke-on-Trent is empty now. The window that faced the motorway is dark. The trader who sat there watching headlights pass at 4 a.m. left behind no legacy except a handful of trades in a database that Goldman archived and then forgot. He did not write a book. He did not start a fund. He did not give interviews after the one local journalist found him. He built a bot, proved a principle, and walked away. And the principle he proved is this: the market's most profitable inefficiencies are not hidden in complex data. They are hidden in the spaces where the institutions cannot see because they refuse to look. The bot did not win because it was smarter than the quants. It won because it was willing to be small, and the quants were not.